All right, welcome everyone. It's 5 o'clock, so we'll get started. Thank you for joining us today. I'm Rebecca with Madison Credit Union, and we're so glad you're here for the Homebuyer webinar. Whether you're a first-time homebuyer or just looking to refresh your knowledge, we're really glad you could join us. Before we dive in, just a quick note that the session is being recorded, so you'll be able to revisit it later or share with any others who might benefit. And we are excited to be joined by Dustin Becker from AmeriCU Mortgage, our partner lender for home purchases. AmeriCU Mortgage is one of the leading credit union mortgage lenders in the country, and we're proud to offer their services to our members. Dustin will be walking us through the home buying process and sharing expert tips along the way. If you have any questions as we go, please feel free to drop them in the chat box, and we'll keep an eye on it throughout the session. And with that, I'll hand it over to Dustin.
Perfect. Thank you so much. I appreciate it, Rebecca. So thank you for having me. I really appreciate the continued partnership with Madison Credit Union. As Rebecca had mentioned, we partner with credit unions throughout the nation. I'm personally in Wisconsin, so the credit unions that I partner with are in Wisconsin. We assist with low down payment options for our credit union partners, as well as government loans through FHA, VA, and USDA. The biggie being the low down payment option, because a lot of credit unions don't have the same risk appetite. So the down payment requirements are, oftentimes 10 to 20% down. So what I'm going to go over is going to be primarily what lenders look at when making a decision and looking at loan programs. A lot of it's going to be somewhat generic information, but a lot of it's really good information that people just aren't aware of. This is going to be super flexible, so feel free to interrupt me if there's any questions on anything. You don't have to wait until the end to ask any questions. So we're going to dive right into the PowerPoint. And are you seeing the home buying workshop slide right now?
Yep, we see it.
Perfect. All right, so how much can you afford? The first step to buying a house is really determining what your budget is. And the budget should really be determined by the buyer. The lender can go to certain debt to income thresholds that aren't necessarily going to be the same comfort level as what the buyer themselves are comfortable with. FHA allows for up to a 55% debt to income ratio, and I'll get into that a little bit further. And that only includes what is being reported to the credit bureaus. So it's not including grocery bills, gas, any of those other items that you're paying for on a monthly basis. So that can occupy a really good amount of your debt. So really determining your budget is the biggest key part before buying a home. What is evaluated by the lender? We call it the 4 C's. Your credit, which is obviously your credit scores, and what's gone into your credit history. Capital, which is the funds that you have, checking, savings, investments, 401k, gift funds, or possibly down payment assistance options. Capacity is going to be your capacity to be able to pay the mortgage. And then collateral is going to be the property type. So we'll get into each one of these. So first is credit. Do you know your credit score? I oftentimes will get into an application with borrowers and they really have no idea what their credit looks like. Many do, however, because of credit cards and different things like Credit Wise and Credit Karma, things like that. So we like to ask the question, do you know what your credit looks like? Because that's really going to have a pretty decent bearing on what loan program you're going to be eligible for. What's all factored into your credit score? The largest piece is going to be payment history. 35% of the total pie you can see is going to be payment history. So those on-time payments or missed payments, which are going to have a huge negative impact on scores. The next largest factor is going to be available credit. that revolving credit is an extremely important piece that a lot of people aren't aware of. Um, you really want to keep those credit cards at or below 30% utilization. 30% is that key number. I always recommend utilizing credit cards because they are extremely important for improving credit scores and keeping your credit scores high. But if it's overutilized, it has a negative impact on scores. So I always recommend paying them off in full if possible. So on $1,000 credit limit, you want to keep those balances at or below $300. Length of history. So that's going to be a length of history on different trade lines that are reporting. Your longest lines of credit are typically going to be either mortgages or credit cards. People often ask, should I cancel my credit cards after you're no longer utilizing them? I really like to say that that's up to the person and what they want to do. However, in my experience, it's best to just leave them open because of that exact thing, that length of history, the time that you've had the credit card for is going to have an impact on your scores.
I have a quick question.
Yeah.
Do student loans count as that length of history for your credit score? Or no.
Student loans do report, yes. So even if they're in deferment, they are reporting to your bureaus. So yes. And Olivia, did you have a question? I don't know if we're able to unmute you. It looked like you may have had a question.
There we go. Now can you hear me?
Yep.
Okay, so you said, not to close out any credit cards that, like I don't use anymore, which is fine, but eventually the credit card companies, after
Close
you
them
don't
for you.
use them, close them for you.
Right.
So which is worse, to close them out myself or let the credit cards close them?
In my experience, it really takes them a while to close those accounts. I mean, sometimes it can be years before they do.
Okay.
I still have some that have not been closed that I've had for probably going on 8 to 10 years. So it really depends on the creditor and what they're going to do. Again, it's just my recommendation because of that 15% length of history and how that affects your credit scores. But it's really up to the individual as to what they want to do.
Okay, thanks.
Yep. The type of credit, so they call that the blend or the mix of your credit. The more different types of credit that you have, the stronger the impact is going to be on your scores. So mortgages, obviously, and then installment loans like your autos and UTVs, toys, and then credit cards and student loans. Those are the biggies that we typically see. Number of inquiries. So inquiries can definitely hurt your scores. There really is never a positive impact from credit inquiries, only negative impact. For a mortgage inquiry, I always get the question, is going to hurt my score. If you have good credit, I mean, whether you have good or bad credit, it's going to impact your score to some extent. With good credit, we typically find that it rebounds back to the same score or similar score to what you previously had within 30 days, 60 max. Mortgage lending, the Fed has implemented legislation so that you can shop around for interest rates. So you can have like 15 inquiries within a 45-day time period, and it looks like one inquiry. So it's not like an auto, like when you go to a dealership and they shoot you off to 8 to 10 different lenders. Each one of those is an inquiry. Just go see your friendly face at Madison Credit Union. So it's just one inquiry. And then, yeah, that pretty much sums up what's all calculated into your credit score. So 3 important things you can do right now: check your credit report, set up payment reminders. We always suggest setting up automatic payments because I do oftentimes hear people say, I just forgot about the payment and it got missed. If it's set up on automatic payments, that's never going to happen. And then reduce the amount of debt that you owe, specifically revolving debt. Revolving debt can really add up and cause some headaches. There's many cash out refinances that I've done in my history on mortgages because of credit card debt. So Next is capacity. Capacity is going to be your ability to pay. So we look at your history of income. The magic number everybody talks about is 2-year employment history. However, if you're employed with different employers over a 2-year period, as long as the employment is similar in nature, that's fine. So again, we look at a two-year history typically, but you don't have to be with the same employer for 2 years. Yeah. Sorry, you're muted yet.
Okay. So my partner and I are looking to perhaps purchase. He works. I have been on disability, Social Security disability for many, many years.
Yep.
Does that have a negative impact on trying to get a mortgage? Or, I mean, that's pretty consistent income.
Social Security income, we can definitely utilize Social Security income. In
Okay.
fact, we can actually gross up Social Security income. Depending on the loan program, we can gross it up 15 or 20%.
What do you mean?
So let's just say you're, for a simple number, you're receiving $1,000 a month. We can actually gross that up to 1,150 or 1,200, depending on the situation, as long as you're not receiving like pension funds or additional income.
Okay.
That can be grossed up. And essentially all they're looking at is to make sure that there isn't anything that's taxable, because the Fed can tax your Social Security, unfortunately, if you're receiving pension income or other items. So
Yeah. Thank you.
Or I can over explain things at times, but I like to provide as much information as possible. So yeah, that Social Security income, perfect. Yep, we can absolutely use that.
Okay.
And is your income likely to continue? That's going to be based on verification of employment. Like in your case, Social Security income. That's not gonna end. So that's a viable source of income. Okay. Different sources of income. You have your non-variable sources of income, like your standard W-2 income, pension income, Social Security, as you had asked, family employment. Honestly, I never saw that bullet on there. I'm not sure what family employment would be. And I would think that would just be the same as W-2 employment, unless you were self-employed, which is on the right-hand side. Long-term disability, if you're receiving long-term disability, that can be utilized. Alimony and child support. Those two items would need a 3-year continuance. So there would need to be documentation of a 3-year continuance in order to be able to utilize those income sources. And note receivable. That's another one that I never noticed being on here. I think this might be an older slide. And then there's the variable income. So variable income is going to be a little bit harder to source, if you will. So like commission income, we have to have a full 2 years of commission income. Most variable income, there's going to have to be a 2-year history to be able to average that income. And that's because commission income, you can make, very little the first year and a lot more after that. So they look at an average. Bonus income, self-employed income, again, 2 years for self-employed borrowers or 1099. Seasonal employment, we are able to utilize seasonal employment, but there needs to be a 2-year history. Hourly, that really, to me, shouldn't be considered variable income. I would consider that to be base or salary. Contract by the job, there are many. Truck drivers is a big one that we see. They get paid based on mileage or contract. Tip income for servers. That's another biggie. A lot of people get paid in cash. We're not able to source any cash income because the federal government wants to make sure that they're getting their tax money. So tips can only be utilized if they're reported. And then overtime income. So we have to have a 2-year history for overtime income as well. Any questions there? You'll hear the term debt to income ratio a lot in lending, whether you're buying a home or buying vehicles or whatnot. What goes into your debt to income ratio? It's literally just your debt divided by your income. and it's just the debt that's reporting to your credit bureaus. So it's not going to be anything outside of what's not report of what is reporting. And that's divided by your gross income. So not your net, it would be the gross income that you take before taxes. PITI, that's going to be the breakdown of your monthly payment for mortgages. That's your principal and interest, which is the mortgage divided by 360 payments if it's a 30-year mortgage, and the interest that's amortized over that 30 years as well. You always pay more interest up front, and then it begins to work its way down as the mortgage progresses. And then the TI is going to be your taxes and insurance and mortgage insurance. So taxes are the property taxes divided by 12. Homeowners insurance is going to be the homeowners policy divided by 12. And then mortgage insurance is going to be on any conventional mortgage through Fannie Mae or Freddie Mac that is at or above 80% loan to value. So if you're not putting 20% down on a mortgage, there's going to be mortgage insurance or private mortgage insurance. They're literally insurance companies. We have access to like 8 different companies that provide insurance. And what they're insuring is the potential event of default on a mortgage. So you're paying monthly. The better the credit, the lower the monthly PMI rate, the lower the debt to income ratio, the lower the loan to value. All of those positive factors are going to reduce the total amount of private mortgage insurance. With FHA, they just call it mortgage insurance because FHA is a government loan and the mortgage insurance is federally backed. So you make a monthly payment. It essentially does the same thing. It goes to pay for those that are defaulting on their mortgages. And then HOA would be homeowners associations if there were homeowner association dues.
So, quick question. So
Yeah.
does all that get escrowed if you just want to send one payment to cover all that?
It does,
is
yes.
that
Yep.
so the escrow fee, is that additional to this or is it included in one of these categories?
Yeah, so when you say escrow fee, there's no additional fee charged for escrow, but the escrow
Okay.
amount, the escrow amount would be your taxes and insurance. And then they bundle mortgage insurance into that, but technically your escrow is your taxes and insurance.
Got it. Okay.
Yep. Any mortgage that does not have that 20% down for the PMI, there's also a caveat where if you put 20% down, you can actually waive your escrow if you would prefer not to escrow. Lenders like to hold that escrow. For one, I'll be transparent. Lenders are making money on the interest on the escrow. But aside from that, the bigger thing is that they want to make sure that those taxes and insurance are getting paid, that their collateral is getting paid. So if you have that 20% down, you can waive the escrows and you can make those payments yourself.
Got it. Thank you.
Yeah, absolutely. How is your debt to income calculated? We kind of went over that already. So it's going to be your total monthly expenses that are reporting to your credit bureau divided by your gross monthly income provides your debt to income ratio. And DTI is extremely important in lending. Along with credit score, I mean, I would say that they probably factor almost equally. There's many scenarios where I have borrowers that are in the 800 scores that are just maxed out, and we're not able to assist because their DTI is too high. So we're typically looking with the mortgage payment. So with the PITI, you're going to be looking at with conventional financing, no higher than 49%. I should say 50%, 49.99 as an absolute max for conventional financing. 45 is much prettier. And you get a break on the PMI rate if you're at or below 45%. So I don't want to bore you with too much information, but the lower the debt to income ratio, the better off you are. FHA financing allows up to 55% DTI. So if you really think about that, it's kind of crazy. It's gross income, so it's prior to taxes. It's not what you're taking home, and it's not including any of your other debts. So that's why every borrower that I talk to, I really like to go over their budget with them and make sure that the payment is affordable for that reason. Capital. So there are several different types of capital. That's going to be your assets. Funds to close is another big piece. Obviously, we need to have funds to close in order to close. So it's going to be your down payment, your closing costs, and your prepaid items. The funds to close don't technically need to be verified until right before closing. Oftentimes, people are gifted those funds and we source them a week before closing. One big thing I like to tell people if they like to keep mattress money or cash on hand, the Fed requires that we source 60 days of bank statements or transaction history. If there's a large deposit, which is really going to be anything over $1,000 or $2,000, excuse me, those funds are going to have to be verified. But if you have those funds on hand and you deposit them 61 days prior to sourcing the statements or the transaction history, it's not going to show up on the transaction history. So just something I like to let people know. Does that make sense?
So basically, if they have money in their mattress just kind of around, it's better to put it in the bank.
Yeah.
60 days.
Yeah. If you know you're going to be buying a house, I recommend putting those funds into the bank immediately because we're going to need at least 61 days so that we can skip that day that it was deposited. Yep. So different types of assets and capital. Checking and savings are typically the most obvious. CDs, retirement accounts, 401ks have been extremely popular lately. So you can take out what's called a hardship withdrawal from your 401k. And the hardship withdrawal typically has reduced penalties. Now, every plan is a little bit different, so you always want to reach out to your plan administrator. But like, let's just say you have a Roth 401k, you've already paid the tax on it, then it's possible that you can take those funds out with no penalty or a much reduced penalty. Hardship withdrawal is something that was set up by the Fed to allow you to be able to access those funds in the event of a home purchase, if you have a baby on the way, any type of a natural disaster is included where you can access those funds.
And are these funds that don't need to be paid back then? Maybe you could just kind of keep them, right?
For the 401k?
Yeah.
Yeah. So my understanding is some of the 401ks that I've seen in the past, they'll have a reduced penalty, but there will still be a penalty. But if you pay it back within 2 years, then there's no penalty at all.
Okay.
So that's why it's important to reach out to your plan administrator just to get a rundown on exactly what that hardship withdrawal looks like. And I'm not an investment advisor, so I always recommend reaching out to your investment advisor specialist.
Mm-hmm.
I'm just always looking for an outlet when somebody wants to purchase a home as to how they can access the funds needed to be able to purchase that home. I'm not a huge proponent of accessing your retirement funds to be able to do that, but it is the largest purchase that you make in your life. And a lot of people have a hard time saving money. And, that's one thing that is just automatically put away and people just tend to have some funds in. So
I have just a quick question.
Yeah.
So, my mom has set up her will and stuff, and I will be, upon her death, I will be receiving quite a large chunk of money. But because of my situation with being on disability and other government programs that I receive, her attorney said that it was obviously best that the money does not come directly to me. So we set up a plan where I'm not included in the will at all, but my third, so it'll be split between three of us. So it's my sister, my daughter, and myself. My daughter will be receiving my portion of the money.
Mm-hmm.
She'll be putting it into her name, and then, allotting me what I need. Now, how would something like that work?
So super simple. All you would need to do is structure that as a gift. We provide a letter that states that you're getting those funds gifted to you by your relative, whatever that relative may be. And then we don't really even need to source those funds any longer. All we need is a copy of the check and a receipt of the deposit into your account.
Okay.
So they've made that pretty easy to do. And that's a very good question as well. So gift funds are very common in mortgage lending, and gift funds can be provided by any family member, out to like third cousins, aunts, uncles. They do get a little bit finicky when it's being gifted by friends. So we have to show that there's some type of a financial interest or some type of an interest in the person that is gifting the funds.
Mhm.
But yeah, I mean, family members are the typical source for that.
So are you talking about money for like a down payment
Mhm.
or the actual mortgage payment? I mean, I,
Well, yeah.
so
So if you wanted to utilize,
I, I, I will have that money available to pay my mortgage. It's just not in my name. So will that be gift every month? So
that's a little trickier.
I can be gifted up to $17,000 a a year, maybe. I can't quite remember. It's quite a extensive situation.
Yeah, and
So
yep, go ahead.
so $17,000 is not really that much when you're looking to put a down payment, on a house. Um, and now I can't remember what I was gonna say.
Well,
um,
the gift funds for the down payment and the closing costs can absolutely be gifted to you. The utilizing those funds into your debt to income ratio would be a bit trickier. So, and I don't know if that's what you're asking, but we do have situations where people have an annuity or have funds that are actually paying them on a monthly basis. And we can either use that monthly payment that's being paid to them, or let's just say they have $1 million in an account that is able to be liquidated. There is a calculation that's used in underwriting, and that's able to be broken out to be able to utilize that into your debt to income ratio.
and
Your
that's something with whatever lender I were to go to, that they'll know what to do, basically.
right, and that's where I mean the guideline books are hundreds, if not thousands, of pages thick. So there are unique scenarios, and that's where the underwriters really shine. That's where we have to reach out to them to get further information. So in that scenario, if you're getting paid that on a monthly basis, or I mean on an annual basis, then that's something we would just have to get into underwriting and get their eyes on it.
Okay,
I hope
thanks.
that answers your question.
Yep.
Okay, perfect. But yeah, those funds can absolutely be utilized towards down payment and closing costs. So,
Okay.
Is
and
it possible?
if she's able to hang on to that 17,000 for 1 year and then carry it over to a next year so that you have, double.
The
But
well, it's 17,000. I don't think it works that way. Um, I don't know. I'd have to really look into that.
Yeah,
okay,
I know there are some regulations on before she would have to pay taxes on the money. Is that what you're saying? You can give somebody so much money and before you have to do with taxes. I don't know if
yeah, and
that,
I thought that number was 16,000, but I could
oh,
be incorrect on
16,000.
that too.
Okay,
Yeah.
okay. Is it possible that she could have the money maybe temporarily in her accounts then? Like, I mean, as a bigger bundle?
It's
Uh,
unfortunately, though, because of like I said, the government programs that I'm
right.
currently receiving, um, I need to legally let these agencies know. So yeah, it's a tricky situation.
Yeah, and it's something that we come across pretty frequently. In fact, I mean, I have a special needs child of my own, so I know that in order to receive benefits, they're looking at all of your accounts. So I totally understand where you're coming from on that. Um, I don't know if maybe you could deposit, if your daughter could deposit some funds into another account, another child or another relative, and then have two separate gift letters. I'm not sure about that. That's something that we have to talk out a little further.
Okay.
Yeah.
Thanks.
But I am happy to answer any of those questions and look into them further for you. So you'll have my contact information, and you're more than welcome to reach out to me at any time.
Okay.
Proceeds from the sale of a home are often used towards down payment and closing costs. So you sell your home to buy a new home. They typically close on the same day, or you close on your sale prior to your purchase, and then those funds are utilized towards down payment and closing costs. Stocks, bonds, and mutual funds, so any investments that you're able to draw from are able to be utilized. And then earnest money. Earnest money is essentially just the money that you're putting down. Typically, it's $1,000 per 100,000 that the agents ask for, and that's like your down payment on a home. That earnest money goes towards your total cash to close. So when that's provided in escrow, then it comes off of your total cash to close at the end. Assets lenders look for, there are some discrepancies in this, in my opinion. Do you demonstrate the ability to save? I work on a lot of files, and I'm just being transparent that people don't really have a whole lot of funds. And as long as they're able to access gift funds from a family member and credit is decent, they're typically good to go. So as long as you're able to access the funds that are needed to close in a legal manner, I don't think this first piece is looked at quite as heavily in the secondary market as maybe some of your brick and mortar or credit union type financial institutions. I think it's looked at a little bit more heavily. What is your cash investment into the property? So that would be how much you're putting down, what the loan to value is going to be. Do you have sufficient cash to close? Again, that just gets sourced right before closing. So as long as you have sufficient funds, you're good to go. And are there cash reserves? So there are situations where reserves are needed. One of them is if you're buying an investment property, you have to have 6 months reserves. So your reserves are your PITI that we talked about earlier, principal, interest, taxes, and insurance. And they would multiply that by 6 for an investment property to make sure that you have at least 6 months worth of payments in an account. In some situations, if the credit's a little bit on the lower side, sometimes they'll ask for 2 months of reserves. Sometimes when we're getting refer findings, meaning that we're not getting an approval. So everything that we do is automatically, it's done in an algorithm in the computer. We put in all of your personal information. We click a button, and then it tells us whether you're approved or denied. And if it's denied, then I look at options as to what we can do to get an approval. Possibly refinancing an auto to get the debt to income ratio down, extending the term out to reduce that monthly payment. Or I'll put in 2 months of reserves if there are reserves or access to reserves, and then I'll get that approval. So always looking at what we can do to get the approval, if not now, sometime in the near future. Excuse me. Large deposits. We discussed large deposits a little bit earlier. Any single deposit that is greater than 50% of the total monthly qualifying income for the loan, that's kind of vague because each program is a little bit different as to how they calculate that. I always like to say any deposit over $1,000 could potentially be sourced. So,
what do you mean by that?
So any deposit into an account that is like cash on hand, that's not payroll or social security or something that's apparent, is going to need to be sourced. So that's where that mattress money that we were discussing, you'd want to have deposited. Yeah, you'd want to have that deposited 61 days prior to closing so that we can just get a 60-day bank history.
Okay.
And then last is collateral, different types of property. So these are all different types of property that we will finance. single family homes, which are going to be your standard homes. Multifamily homes are going to be investor based or owner occupied. So we get a lot of duplex purchases that'll be owner occupied. So you live in one side, you rent out the other side. Down payment requirements in that scenario, FHA is 100% the way to go. They only require 3.5% down, whereas the other programs look at as investment, where you have to put 15 to 20% down. But we do definitely finance multi-unit properties, townhouses, villas, which I would assume villas are probably like zero lot lines, similar to townhouses. Condos, we do quite a few condo loans, especially in our southern market. In Florida, a lot of condos. Most of the properties that we finance are condos. Manufactured and mobile homes. So mobile homes are manufactured homes. Single wide and double wide are manufactured homes. We will finance both as long as they're secured by real property. So not in a trailer park, essentially. Those properties have to be manufactured after 1978, just because of lead-based paint concerns. But outside of that, we will definitely finance manufactured homes. They are considered more of a depreciating asset, so the interest rates can tend to be a little bit higher on the manufactured homes than on the other options. And then the different programs that are available. There's actually subsets to a lot of these programs. So under conventional loans in the old terminology, conventional loans are through Fannie Mae and Freddie Mac. So they're hedge fund money, Wall Street investor money. I want to say I heard 90% of all mortgages that are procured throughout the United States are secondary market Fannie Freddie programs. They are typically preferred by listing agents and sellers.
1 minute.
You're fine. I've got two myself. I've been hoping that they weren't going to be barking in the background. Good. So the conventional mortgages, especially in this competitive environment, are the preferred financing type. Financing through credit unions and brick and mortar are oftentimes called conventional financing as well. They're portfolio, so they're funded by the credit union or by the brick and mortar bank, like community bank, but they're lending their own funds. So that 10 to 20% down, they're lending their own funds. It's considered conventional financing. It's underwritten within the financial institution, whereas ours are federally audited and would be investor money. There's both fixed rates and ARMs available in those conventional programs. As little as 3% down or 5% down, depending on whether you're a first-time home buyer or not. And then there's the government loans. FHA, VA, and USDA are the three government loan products. VA is going to be for current or prior veterans. I'm sorry, I got a tickle in my throat. So VA is going to be for current or prior military. It's a great program, 0% down. There's no mortgage insurance with VA. So there's a lot of great benefits with the VA program for the vets. FHA I've gone over a little bit. That's another very common program, a 3.5% down program, geared towards higher debt to income ratios. As I mentioned, they'll go up to 55% DTI. They'll also finance lower credit scores. In fact, you can finance sub 580 scores with FHA. 10% down is required if you're sub 580.
What does that mean?
Credit score. So if your credit score
okay.
Yep, at or below 580,
Okay.
then 10% is required. And typically they want to see some assets too, in order to get an approval at that sub 580 score. FHA has mortgage insurance. That pretty much sums it up. FHA isn't quite as desirable by listing agents and sellers. More so in the last 4 or 5 years in the super competitive market that we're in, only because listing agents have been in the business for a long time. FHA loans have a little bit higher propensity to not make it to the closing table, and only because they do finance those lower credit scores. And there can be situations that can come up in underwriting that can cause the file to not necessarily make it to closing. We're talking a very small percentage, but a larger percentage than what the conventional mortgages would be. So the other piece that's probably even a little bit bigger than that is the property requirements for all government loans. Lead-based paint concerns on all homes that were built prior to 1978. If there's any chipped or peeling paint, they're going to require that it be scraped or sanded and repainted. Whereas conventional financing, they're not going to require that, along with several other property requirements, chipped and peeling paint, along with the stairwells on porches and decks, and any safety concerns, windows that have cracks or glass missing. And then lastly is USDA, which is rural housing, which is also a 0% down program. It's going to be for any areas that are not major metropolitan areas. So really anything outside of Madison proper or any of the larger suburbs. Any of your smaller towns, I would say anything less than 5,000 to 8,000 people. I think Beaver Dam is even included in USDA, if I'm not mistaken. So any of your smaller towns are absolutely going to be included, or anything that's out in the country. Rates tend to be a little bit higher on USDA because you are financing 100%. Not the case with VA because the Fed is actually picking up a portion of that. So in summary, credit, capacity, capital, and collateral, the 4 big items that are looked at and reviewed for the ability to finance. So that pretty much sums up the homebuyer seminar portion of what we're going to go over. Do you have any questions on any of those pieces that we went over?
I'm sure after if my partner watches this, we'll have 100 questions. So,
so hang on to my contact information and reach out to me. I have my cell phone number included with my business card. Yeah, I brought up the wrong presentation here. This is my manager's presentation, Eric Kelly. So I'll make sure that you guys all have my contact information as well. Unless, Rebecca, did you put that in the presentation anywhere? In your email?
No, but I can put that here. I can put that in the chat right now.
Okay, perfect. Feel free to reach out to me anytime. I'm totally cool with you reaching out to my cell phone number. That's actually my preferred method, or you can shoot me an email and I'm happy to answer any questions.
Okay. And that will be included at the end here, or what? Your email, your phone number?
Yeah.
So yep. I just sent it here in the chat. Do you see the chat?
Yeah. Oh, okay. Yep, I have it.
Yeah, so the easiest way to reach me is going to be at my cell, which is 920-203-0853.
Okay.
Excuse me, or my email at dbecker@AmeriCU.com. dbecker@AmeriCU.com.
Okay.
And I can send a link to everybody who registered with your contact information and with a copy of the video too.
Excellent. Thank you.
Mm-hmm.
Now, I know that there were a few items that there were some questions on. Tips for purchasing in this climate. This comes up pretty frequently because of how competitive the market is. Homes are selling for crazy amounts. There's 10 to 15 offers on all properties. I will say that the market is slowing a little bit. There seems to be more inventory on the market. There aren't as many offers on each property. We're starting to see some contingencies removed from the offers, or I should say added to the offers actually. So the inspection contingency was something that we were seeing removed from offers for about 1.5 years. Like there were almost no offers coming through with inspection contingencies. And I apologize if you hear any background noise. My son's coming back in with his therapist. So but yeah, the biggest thing in purchasing in this climate is being flexible.
Quick,
People just
I'm sorry to interrupt. Quick
Yep.
question. With the things that are happening in the United States right now, um, if we go into a recession, which is debatable whether or not that's going to happen, that would be more of a buyer's market then at that point.
Not necessarily. I would say that economists would say that we've kind of been in a recession over the last 3 to 5 years. So I think that there's actually a lot that goes into that. I think that the biggest thing as of late is the lack of inventory that's been causing the market to be the way that it is. Obviously, interest rates are and have been at an all-time high. They were almost 8%, so we're at like 6.25, 6.5. So that actually feels good compared to the 8% that we were at. But it'd be really nice to get back down to 4.5. Really nice. I don't know how much of an impact. I think that if we went into a depression, we would see a lot more inventory. I think that people wouldn't be able to pay their mortgages, and I think that would definitely shift the market and cause home prices to come down.
Hold on a second.
Yep, no problem.
Come in. Sorry.
No, you're fine. So yeah, I can't fully answer that question. I don't necessarily foresee, knock on wood, that our economy is going to fail and we end up going into a depression and home prices are going to drastically drop. I think we're probably just going to have to realize that home prices are where they are. And I don't think we're going to see much more of an increase percentage wise that we have over the last 3 to 4 years. But yeah, long story short, it's a competitive environment.
Yeah. Yep.
Unfortunately, it's made things tough for a lot of people. Monthly payments are a lot higher than they used to be when I first got into this business. 3% interest rates and homes average pricing was 150, 200,000. That's just no longer the case. And we're talking 7 years ago. It's crazy how things have shifted in such a short period of time. So yeah, I hope our economy doesn't get any worse. I know that there's a lot of uncertainty and a lot of instability. Okay, so tips for purchasing in this climate: get pre-approved right off the bat. All too often, people are looking on Zillow. They find a house that they really like. They don't realize that home might already be under contract and hasn't been updated online. Get your pre-approval. Get in front of a buyer's agent and get the listings from the actual NMLS because it'll just really give you a leg up to get things rolling.
And once you get a pre-approval, I'm sorry. Once you get a pre-approval, it should last, what is it, 90 days or a certain amount of days?
Yep, they're good for 90 days.
90 days.
Yep. After 90 days, we're supposed to pull credit, depending on the credit situation and the conversation that I have with the borrower. If they tell me that no new lines of credit have been taken out, I'm cool with not pulling a new bureau. But it all just, it depends on what the credit situation looks like. Patience and flexibility, the home inspection contingencies that I went over. There are homes out there that need upgrades. And if they're outdated, you can typically buy them at a lower purchase price. We offer renovation loans. That's one thing that I didn't go over with those loan programs. There's subsets for those loan programs. FHA has a 203K program, which is a renovation loan. You can renovate kitchen, bathroom. You can do some pretty extensive renovations and it can be included in your loan. So your 3.5% that you would put down on FHA on a renovation would be based on the completed value. So it would be your purchase price plus whatever it would cost for the renovations minus your 3.5%. And that's what the appraised value would be based off of too. Working with a listing agent rather than a buyer's agent, I don't typically like to recommend this, but oftentimes if you see a listing that's out there and you reach out to the listing agent, if that listing agent has both sides of the transaction, there's a financial benefit to the listing agent. So sometimes it's beneficial to just work directly with the listing agent rather than getting a buyer's agent. But I always like to say the listing agent is representing the seller, not the buyer. Even when they are your agent as a buyer's agent, they first off represent the seller. So who qualifies as a first-time home buyer? So first-time home buyers are going to be any borrower that has not owned a home within the last 3 years. So that's literally all it is. If you owned a home within the last 3 years, you're not a first-time home buyer. If you haven't, then you are a first-time home buyer. If there's two parties on a mortgage or on a loan, one of them has owned a home or currently owns a home, and one of them is a first-time home buyer, that borrower pair is considered a first-time home buyer. So only one party has to be a first-time home buyer. With those first-time home buyer programs, there's some down payment assistance that's available depending on income limits. And that's going to actually segue into the next aspect of home ownership assistance, which would be community grants or down payment assistance. They're almost all income based. So the community grants that you're able to get within the county or within your city, there's a lot of different programs out there, and I'm not familiar with all of the programs that are available. They're county specific, city specific. I always tell borrowers to hop on Google and do some research to see what's available in their area. But we'll work with any down payment assistance program that will be second on the lien or not be on the lien at all, if you will. That's pretty rare, but a lot of these down payment assistance programs will actually be forgiven after 5 to 7 years if you keep your mortgage, or if you stay in that house for 5 to 7 years. There's grants out there that'll give you $5,000 to $10,000, and you don't even have to pay it back. So those grants are good to look into. We offer through FHA a new program that offers down payment assistance with FHA. So it's the 3.5% down that's required with FHA is financed as a second. That second mortgage is literally a second payment that you would have. The rate is 2 points higher than what your standard rate would be. So, the going rate right now is 6.5-ish. You'd be looking at 8.5-ish on the second for the 3.5% down. But it is a great option for those that don't have access to down payment assistance, and there are no income limits with that FHA down payment assistance, which is great because pretty much every other down payment assistance program out there has income limits. Those income limits are based on the area median income. So whatever the area median income is for your county or the area, it's 80% of what the area median income is. So we find somewhere around 100,000 for the most part is the area median income in most areas in Wisconsin. So like 80,000 would be that threshold, but it really depends on the area. It can fluctuate a bit. And then we do offer some down payment assistance through Fannie Mae and Freddie Mac, or I should say Freddie Mac and Fannie Mae offer the down payment assistance. So there's up to $2,500 in free down payment assistance that's available through both Fannie Mae and Freddie Mac. And those are income-based as well, but great programs. Those income-based programs also provide for a 10% break in the PMI rate, which that can add up over time. So 10% break in the PMI rate, a little bit better interest rate for those income-based borrowers, and some down payment assistance. So that pretty much sums up the homeownership assistance that I'm familiar with. I really always recommend to borrowers to hop online and look to see what's available to them in their county, in the area that they reside. They do look at number in household. So if there's multiple household members, your income is based on the number in household with those community grants for the most part. Any questions? I think you're on mute. Yep.
Sorry, I'll do some research too quick and see if there's anything I can send that in the email that I send to you, to everybody.
Okay.
Now, how will I be able to rewatch this? I mean, where is there going to be a link for this, or let's?
Yeah. So I'll have it on our website, but then I'll send a link out. Once I get it live, I'll send a link, and you can.
An email.
Yeah.
Thank you. Yeah.
Yeah, and thank you for being on the webinar. We greatly appreciate it. I love spewing all the information that I know, and I like people to be knowledgeable about what they're getting into because, especially first-time home buyers, it can be pretty cumbersome for them.
Yeah, there's so many different aspects to home buying.
Yeah, there really is, and every situation is unique.
Along the way, and you're like, oh, I want about that.
Every situation is unique, so I always tell borrowers, depending on what the situation is, prior divorces, bankruptcy, foreclosure, there's so many situations out there that the guidelines have different requirements for, and that's where I come into play. That's where I do the research and help you out. So
great. Well, thank you so much.
Yeah, thank you.
Yeah, thank you.
Thank you guys for coming. If there's no